Something happened to SCHD in 2025 that changes the whole story. It's not hype, it's right there in the holdings. This year's reconstitution wasn't just routine, it was major. Energy stocks came rushing in, while other big names got cut. And yet, the usual analyst notes, they barely mention it. That gap is where the opportunity lies. If you own SCHD, this matters. If you're watching from the sidelines, it matters even more. And here's a hot take. SCHD right now feels less like safety and more like a bet. Before we dive deeper, a quick but important note. This is not financial advice. I'm simply sharing facts, data, and analysis from public sources. Always do your own research. Always talk to a licensed advisor before making decisions. Now, here's the roadmap. First, we'll check SCHD's vital stats. Then, we'll walk through the big 2025 reconstitution. After that, we'll uncover why analysts are missing the story. Finally, we'll end with a practical checklist you can use today. Chapter 1. Quick Facts Snapshot. Let's start with the basics. SCHD stands for the Schwab U.S. Dividend Equity ETF. It's built to track the Dow Jones U.S. Dividend 100 Index. That means it follows clear rules. Only companies with solid dividends and consistent financial health make the cut. The fund launched in October 2011, and here's the part investors like. The expense ratio is just 0.06%. That's cheaper than almost anything else in the dividend ETF space. Now, what about today's numbers? As of mid-2025, SCHD trades around $27 to $28 per share. Its dividend yield sits between 3.7 and 3.9%. That's more than double the S&P 500's yield. And it matters in an environment where investors are hunting for reliable income. How about the size of the portfolio? It holds about 100 stocks. Names you'll recognize: Coca-Cola, Verizon, Chevron, and yes, a lot more. And here's something else worth noting. SCHD doesn't just pay dividends, it grows them. Over the past 10 years, dividend growth averaged more than 10% annually. That's not hype. That's measurable performance over a full decade. Put all that together, and you've got a low-cost, high-yield dividend growth machine. Chapter 2. The 2025 Reconstitution. What changed and why it matters. Now, here's where things get interesting. Every year, SCHD goes through a reconstitution. That means the index drops some companies and brings in new ones. Most years, the changes are modest, but 2025 was different. Roughly 20 stocks came in, and about 17 went out. That's close to a 20% turnover. For a rules-based dividend ETF, that's a big shakeup. The biggest story? Energy. The fund's exposure to energy stocks jumped to about 21%. That makes energy the single largest sector in SCHD right now. Names like ConocoPhillips, Halliburton, and Ovinitiv are suddenly front and center. At the same time, some big names left. Pfizer is one. BlackRock is another. Those exits show the rules are being enforced, not bent. So why does this matter? Because a sector tilt like this changes the fund's behavior. Suddenly, dividend income is more tied to oil and gas cycles. That means higher potential upside if energy stays strong. But it also means more volatility if energy weakens. This reconstitution wasn't just routine. It rewired SCHD's risk and reward profile, and many analysts are still treating it like business as usual. Chapter 1. Why analysts are missing the momentum. So why are analysts missing the story? It comes down to focus. Most analysts only look at past price performance, but SCHD's momentum is not just about price. It's about structure, yield, and income growth. Take the sector tilt. Energy now makes up over 21% of the fund. That's a big move compared to peers that stayed heavy in financials or healthcare. It's contrarian. It adds volatility, yes, but it also brings in income streams that rise when oil and gas prices are strong. Next, compare yield. SCHD pays close to 3.8%. The S&P 500 pays only around 1.3%. That difference is huge for income-focused investors. Yet many analysts gloss over it. Then there's dividend growth. Over the last decade, SCHD grew dividends by more than 10% a year. That's not luck. That's rules-based selection doing its job. And don't forget flows. Institutional investors are not dumping SCHD after this reconstitution. Coverage shows many are treating it as an accumulation window. That signals confidence, not weakness. So here's the takeaway. Price charts don't tell the whole story. Analysts focused only on past performance are missing the real drivers: income yield, dividend growth, and a sector tilt that creates new momentum. Chapter 4. Practical Implications for Investors. Now let's make this practical. What do you actually do with SCHD in your portfolio? First, remember its role. SCHD is an income and value tool. It's not a growth rocket. Use it as one slice of a diversified plan, not the whole thing. Second, think about timing. Reconstitution happens once a year. That's when turnover is highest. Buying in stages around that window can help smooth out price shifts. Dollar cost averaging works well here. Third, dividends matter most. If you reinvest them, you grow share count when prices are weak. That compounds your yield on cost over time. It's a quiet but powerful effect. Fourth, know the risks. The new energy tilt makes SCHD more cyclical. So, size your position carefully. Don't overload, and if you're cautious, set stop-loss rules or clear exit triggers. Finally, remember costs. With an expense ratio of only 0.06%, SCHD is already one of the cheapest ways to get dividend exposure. So the practical play is simple. Use SCHD as a dividend growth core. Reinvest the payouts. Watch the reconstitution each year. And size your allocation to match your risk comfort. Chapter 5. Analytical Checklist. 7 signals to watch every quarter. Let's wrap up this question with a simple checklist. 7 signals. Check them every quarter. 1. Watch the dividend yield. Compare it to treasury yields. That gap tells you if SCHD is attractive. 2. Monitor sector weights. Energy now leads. See if that rises or falls. 3. Track the actual dividend payouts. Are they stable, rising, or cut? 4. Review reconstitution details. How many names added or removed? 5. Follow fund flows. Are big investors buying or exiting? 6. Look at oil prices. Energy weight means commodity moves matter. 7. Check interest rate news. If the Fed holds rates high, competition from cash rises. Keep this list handy. Quarterly habits like this turn noise into signal. And with SCHD, signals matter more than headlines. Chapter 6. Short case study. Let's run through a simple example. Say you invest $10,000 in SCHD. Current yield is about 3.7%. That gives you roughly $370 in dividends during year 1. Now assume dividends grow at only 4% a year. That's conservative, given SCHD's long-term history of over 10% growth. But let's keep it safe. Each quarter, you reinvest those dividends. What happens? Your share count grows, even if the price stays flat. By year 5, you're collecting more dividends simply because you own more shares. And that's before any price appreciation. It's just the math of reinvestment. The lesson is simple. Steady reinvestment in a dividend growth fund compounds income. It's not flashy, but it's reliable. And over time, the gap between cash savings and reinvested dividends becomes very clear. Chapter 7: Risks, YouTube compliance, and explicit disclaimers. Now, let's talk risks. First, the new energy tilt. It ties more of SCHD's income to oil and gas cycles. That means higher volatility. Second, sector exits like Pfizer show that even stable names can get cut. Dividends aren't guaranteed. Cuts do happen. Third, competition from cash is real. If treasury bills pay close to 5%, investors may move away from ETFs like this. So, a quick disclaimer. This video is for education only, not financial advice. Always do your own research and always consult a licensed advisor before investing. So, what do you think? Is SCHD now a stronger income tool or just riskier energy play? Drop your thoughts in the comments. If we can get 10,000 likes on this video, I'll be sharing a full spreadsheet model in the next video. So hit subscribe and don't miss the deeper dive into the numbers.